Welcome to DLSN, a podcast brought to you by McGuireWoods. DLSN promotes the advancement of women in private equity and finance through conversations with women in the private equity and finance space. These conversations provide both insights and practical takeaways to inform your deal work and enhance the culture of your organization. If you're ready to drive the industry toward a more inclusive and diverse environment, then it's time to come to the table.
Welcome, everyone, to DLSN. My name is Phyllis Young. I am a debt finance partner at McGuireWoods. Today, our guest is Beata Kirr, who is the Managing Director and Chief Impact Officer at the Copia Group. Welcome, Beata.
Thank you so much, Phyllis.
I'd like to start out the podcast if you could tell us a little bit about your background and how you got to this point in your career.
Well, it is a winding road, although it was a little bit linear in the sense that where I'm at this point in my career as the Chief Impact Officer of the Copia Group is only 12 months old. And the rest of my career has been in investing predominantly in the traditional markets. I spent 17 years at Bernstein Private Wealth and really proud of the work that I was able to do there in a very high quality firm. I ultimately was the co-chief investment officer at Bernstein, and I was overseeing, along with my partner, $100 billion in private wealth assets. We had a large team and a large diversity of asset classes. But within that role, there were two aspects of my role that were a smaller part of my role, and I ultimately decided I wanted them to be a full-time part of my role. And those two aspects were building the ESG and impact investing suite of strategies that ultimately grew to around $7 billion at Bernstein. And also, I was the founder of what was called the Women in Wealth Institute. And that was really about lifting up women's engagement with money. Simply said, another way, getting women comfortable talking about money, owning the power of their wealth, and really directing capital in a confident way. And so that work combined really led me to this place at Copia, where my job is to ultimately measure the impact of our investments and to work in a 100% mission-aligned firm. So when I say it was winding, I had a very linear path at Bernstein, working my way up to that senior role for a very long period of time. And then I liken it to kind of jumping off the high dive and going into the deep end of the swimming pool. And that's where I find myself today at Copia, because the deep end is really launching a firm and a fund. It's a 6-person firm. So it couldn't be more different than where I was at Bernstein.
That is a very impressive background. I'm sure in a lot of ways you were blazing trails as you were moving to the point where you are now at the Copia Group. What characteristics do you feel have benefited you in your success?
Well, I have always been a very curious person, and I don't take no for an answer very lightly. I'm kind of dogged in my pursuit of understanding the full depth of the situation and really looking around corners and seeing forward. All those things are related to the same characteristics that since I was an analyst at the age of 21, I didn't really look at a job description and say, this is my job. And I would do my job. I thought I did it well, but I also always asked questions. I always wanted to understand trends. I wanted to interpret those trends. And that really led to, like you said, a lot of disruption and being a change maker and an innovator. And I was really proud of how I was able to influence change at Bernstein and then, ultimately do the same here at Copia. So I think those skills serve everybody well, no matter what their tenure is.
Do you feel that a lot of times were you the only woman or the only junior woman or the only senior woman when you were in those roles?
All of the above, Phyllis. Senior, junior, financial services is not an industry where women dominate. I'm seeing progress and certainly more women in the pipeline. And one of the things that's been so awesome to see as I've made this leap into the deep end of impact investing in the private markets at Copia is there are a lot more women on the other side that I'm engaged with in this space than the traditional, what I'd call Wall Street space. Now, Bernstein was a fiduciary and is effectively a large registered investment advisor of the private wealth business. So it's not a traditional broker-dealer, but nonetheless, it's a publicly traded firm. It still has kind of the hallmarks of Wall Street firms in terms of a little bit of the 24/7 client service mentality, I think it's fair to say is expected of you in those calls. And I'm really intrigued to see how it's different in the foundation space, in the family office space, in the pension space, and certainly in the impact investing space. And what I mean by that is I'm seeing a lot more women and a lot more diversity in general. So I'm encouraged by that because there's not just one space in financial services. There's all different avenues you can take to be an investor. And I had just taken perhaps the more traditional route where I was very commonly, quote unquote, the only, but it's not that way in all aspects of investing.
Right. So I think that shows how the industry has changed, is changing. What are some areas, you sort of touched on this when you talked about your background, that I was really starting to pick up on. What are some areas in finance that you are really passionate about?
Well, it's probably already clear that one of the things I'm really passionate about is the idea that capital can do more than deliver strong risk adjusted return. Capital is a powerful tool in making change in our society, and how that change is made can be in terms of what you're backing, the products that the company makes and their impact on people and planet, or it can be who you're backing and their impact on people and ultimately their wealth and societal outcomes. So that in short is really what impact investing is about. And that's why I decided to make this midlife shift into the deep end of the pool in a very different structure, in a very different way, to really focus on it 100% of the time. Because capital is an incredibly powerful tool in enabling change. And it doesn't always have to be at the venture stage. Venture is really important to get companies up and going, but that needs to continue in later stages of company growth in either credit or in equity. And we need to continue to offer capital to social entrepreneurs. And so that's clearly what I'm most passionate about at this stage.
When we spoke previously, there were sort of 3 words, or I guess technically 4 words, phrase that was really important to you: purpose, private markets, and impact. And so I was wondering if you could talk about each of those 3 ideas. We'll start with purpose and maybe tie that into now what you're doing at the Copia Group.
Yeah. And those 3 words, thanks for referencing them, Phyllis. I had written down those 3 words really at the beginning of the year that I ultimately decided to go forth with this deep dive into the pool as my guiding light, as words that mattered to me. At Bernstein, we had this exercise called the values exercise that we did with a lot of our clients. It was incredibly meaningful because, not surprisingly, people of wealth find themselves in a position where at some point the early goal was to accumulate wealth. But then when you have that wealth, the goals change and there's less fulfillment around money. And it's not that different for careers, right? It doesn't really matter at what stage you're at, but at some point your priorities shift and your values shift once you've met your basic needs and you think about your influence and impact. And that's the stage where I was. And so I did this values exercise, and those were the words that really came up as important to me. And purpose meant that my 24/7, I wanted to align all the hours I put into work in thinking about what the end goal was. And for us at the Copia Group, economic inclusion and focus on the wealth gap in our society in the US is really our purpose. It's really our mission. What we are doing is primarily funding ethnically diverse and women-owned or led businesses with growth capital. And that growth capital is credit, it's debt. And so that means we are not taking a share of their equity in providing that capital, meaning it's non-dilutive. And that's a very specific purpose. That purpose is there because the wealth gap is huge in this country in terms of who owns businesses and how much equity they have. And business equity is the primary driver of wealth in America. So what we're doing at the Copia Group is, 100% purpose aligned in the sense that we're providing that capital for growth and we're enabling the business owner to retain their equity while doing so. And so we think it's a pretty unique proposition as a firm and as a fund. And that's what that purpose meant for me in terms of my choice to join the Copia team.
When you were making that evaluation and deciding for yourself personally, but maybe also for some of the women or listeners, what are some sort of practical things when people are making that decision on and evaluating and determining purpose? I think sometimes that initial step scares a lot of people because they have to switch gears, do things in a different way. What sort of practically are some things that either you thought about or that people should think about when they're deciding on that purpose?
Well, I didn't write down the word practical next to purpose and impact in private markets, but it might as well have been there because I've always been a practical person. It's a lot to do with my background and upbringing and just the idea that I was always focused on the practical outcome. How do I pay back my loans? What's the first job that's going to have the fastest ability to do that? How do I get to the next step? And the next step was always a driving force for me. I didn't mention earlier, but I'm an immigrant here. I came here when I was 5. We were political refugees. I was born in what was then the Soviet Union and what is now Latvia, and watched my parents rebuild their life, both of them highly educated scientists, had to redo medical school, had to learn English, had to make their way in this country at an age, in their early 30s. That was just extraordinary to watch as an only child, how difficult that path was. And so for me, the practicality of this choice and the ability to make this choice was always there, right? I don't have the ability to risk everything without that practical background. So I guess my advice here is in the values assessment is thinking about the best way that you can align purpose with, a risk managed approach. And for me, that meant that I wasn't the founder of this business, but I was very happy to join the founder. It was my ability to say, I trust him. I trust the business plan. I trust the path that we're on. And I believe in our ability to be successful in that path. There is a leap of faith that's required with that because there's never a guarantee, but it was a relatively risk managed way for me to jump into the pool, right? I feel like I have a floaty. I don't have, I can swim and I have a floaty. So I guess that's a good analogy.
Yes, I think that's helpful. So it's like making that risk assessment, figuring out how much risk you are willing to take, but also knowing there's going to be some risk that you have to take.
No decision is without risk. And the status quo also has risk, right? At some point, it's certainly easy to stay, as many people have said, in the cushy corner office. And it was a cushy corner office. It was a very demanding job, but it was a big title and a big paycheck and a big role. And it took a lot of soul searching for me to leave that corner office. It took months, actually, for me to get comfortable with it. And I was still scared about the decision. And I think it's really important to be honest about that because career change and radical career change and entrepreneurship is really not for the faint of heart. But that being said, it's exciting. It's aligned, from a mission perspective and a purpose perspective. And I guess I went into it with the idea of, if not now, when, and asking the question more of why not rather than why. And I think that's the frame of mind you have to be in to take that leap. And it's the frame of mind that many managing partners and founders of funds have. It's never an easy path, but it's a really fulfilling one.
That's very enlightening and I think really good advice for people because you're right. Even if you stay in the status quo, there's still a risk associated with that. And what I'm taking from that is ultimately what you want to do or what you should do is find things that you have that purpose, what you're passionate about, be willing to take some risk, even if that risk is keeping the status quo, but just making sure in a sense you're sort of being authentic and true to yourself and doing what you want to do and fulfilling what you believe is your purpose. Let's switch gears a little bit to the private markets. So I'm really interested in hearing why private markets was sort of the second point that you had on your list.
Yeah, and this obviously correlates to my experience as an investor in those 17 years, that my view of outcomes and risk-adjusted return evolved along with the market evolution. And there were a couple of key facts driving the decision to write that down. And it's correlated to the third word, impact, right? They were not considered without the other being related. So first of all, there are less publicly traded firms today than there were decades ago. There's been a conscious decision by many organizations to stay private. And that has been driven by the fact that the public markets, as much as I believe in the regulatory aspects of the public markets and the liquidity that the public markets provide, what's undeniable is the pace of expectations is quarterly. And the punishment for quarterly disappointment is steep. And in fact, those punishments have become bigger, right? So if you had just this week, Nike had a big earnings miss, substantial impact on their stock price. And those movements have become exaggerated as there's more quantitative funds, more kind of similar focus on risk management in funds. In short, it's become more difficult to outperform as a public market investor. So passive has really won for a long period of time, at least in the large cap US space. And that was a space where I spent a lot of time investing. On the flip side, the private market investor universe has grown substantially as there's been more private companies to invest in and back. Exits have continued to ramp up and returns have been substantial. So the return and risk opportunity when you're willing to give up liquidity is just much higher than the public market return opportunity. So I started to shift not only personal investments, but our client investments at Bernstein became much more exposed to the private markets and continued to learn and grow with the asset class. And the private markets, remain very interesting places to invest, whether you're venture capital, private equity, or in our world, private credit has really grown up officially as an asset class since 2008, the global financial crisis. So there's a lot of appeal from a return and risk perspective in the private markets. And then if you don't mind, Phyllis, I'm going to bring up the third word, which was impact, because I mentioned they're correlated. And if you're going to be an impact investor and a serious impact investor, meaning from the outset of assessing an opportunity, you are assessing your impact additionality. You are assessing what you want the impact outcome to be. You are designing KPIs to measure that impact, and your impact team is part and parcel of your deal team. These are all the criteria that I would say need to be in place to be a serious impact investor. All of those things are better accomplished in the private markets. And it comes back to this idea of impact outcomes tend to be longer term outcomes, whether they're environmental or whether they're social. And quarterly measurement of them isn't really well aligned. And therefore, I think impact is best achieved in the private markets. And so that's why those two words really have to be tied together as to why I wrote those three words down.
I see how they're connected. So sort of tying those two together, those two ideas together, do you think private equity versus private credit? What are your thoughts there? Because I feel like a lot of entrepreneurs, and probably particularly a lot of entrepreneurs maybe with that impact mindset, in order to really get up and running, may be more inclined to give up equity versus taking on some debt. I don't know. That may just be an impression that I have, but I'm curious to get your thoughts on sort of the equity side versus the private credit side as it ties to impact.
And I think the way the market evolved is private equity by far outweighs private credit in terms of the assets available to entrepreneurs. So the question I have that's yet to be answered is how much of that perception is based on the availability of capital from one versus the other. Because of course, private equity has been out there for a much longer period of time in a fund form, in an asset form. Private credit has effectively previously been available through the banking world, and the banking world stepped out in a big way. They used to be 70% of the market in terms of providing debt to lower middle market businesses, and today are closer to 10%. And we believe those numbers will continue to decline as the large banks now have to meet Basel III regulatory standards in coming months. So the point is that the capital provider landscape has long been dominated by private equity, and the tides have shifted in the debt space by who the providers are. So you're on to something for sure, because we think it's really important to educate entrepreneurs as to what their options are. And what we're finding at the Copia Group is that oftentimes entrepreneurs, and we're really focusing on later stage businesses in the sense that this is not venture debt, what we're doing. We are working with mature businesses that have EBITDA north of $1 million, revenue of $5 to $150 million. So that's still on the small end in what's called the lower middle market, but that doesn't mean they're new businesses. First deal that we allocated to, it's a company that's been around since 1989. They were not considering private equity as capital, but they had used different forms of debt capital that turned out to be much more expensive than our capital when we came in. And it was just a robust discussion around balance sheet optimization that led them to work with us. So I think, Phyllis, you're right that private equity adds tremendous value to an entrepreneur at different stages in the business through all the various services that they can provide and that they do provide. But what we're finding more and more is that entrepreneurs are potentially interested in combining the capital, or at later stages may have done private equity earlier on, and now because of that equity give up for a shorter period of time are very willing to consider debt for a 5-year loan to get them over the hump of growth, and maybe they come back to private equity again later, but they've retained more of their equity, they've grown their business in the meantime. I don't think it has to be an either or, is my point. I think it can be complementary and also dependent on the stage of the business.
As an impact investor, who are the key stakeholders from your standpoint? I think people have different perceptions of what impact investor means. And so I'm curious to drill down a little bit more on that. And what does that mean to you? And who are the key stakeholders from your standpoint?
Yeah, I really appreciate the way you asked the question. And I also appreciate just the general confusion around what does impact mean, because there's been a lot of confusion in the space. And I want to delineate definitions before addressing our stakeholders. ESG does not equal impact. That's the first thing I want to say. That ESG is really important as a scoring mechanism, as a rubric of the types of things that matter. But in many cases, especially in the public markets, ESG scoring and ESG teams are really looking at kind of risk management and backward-looking assessments to say, how much risk does this company have on these criteria? You flip the script when you talk about impact investing, because when we come into an opportunity, what we want to measure is the forward-looking additionality of our capital. So if we're putting out a $5 million loan, a $10 million loan to a business, what we care about, the stakeholders for us are who benefits from that capital and how do they benefit. And you can see why it's not a quarterly assessment, because the types of benefits we care about the most at Copia is who. So we start with the idea of who owns the business, who are the people that own the business, who leads the business, who works in the business, and then ultimately, who are the suppliers to the business, and then how do they pull talent pipeline from the community. So if you think about a continuum of stakeholders, kind of from top to bottom or left to right, whichever way you want to read that, the people are our key stakeholders. And what we care about for those people is their access to economic mobility, and in the workplace, in particular in the employee base, how inclusive is that access? So we will be looking for information on job growth, on wages, on benefit access, on leave, the amount of leave that is available for employees, how many are taking it and how much do they take? And not just the primary caregiver, but all caregivers we find is an incredible indication of an inclusive workforce. Upskilling and reskilling access, educational and tuition reimbursement benefits, retirement benefits, And things like ESOP plans and economic ownership in a workplace, we love to see as well. So it gives you a sense of the type of criteria that we look at to assess really financial wellness in all of those stakeholders. That's how we define impact at the Copia Group.
And how does that impact translate into ultimately returns at the companies or success, proof of concept, financial performance for you?
Yeah, I really appreciate the question because impact and financial outcomes here, just like private and impact, are intertwined. These are intertwined. We are a fiduciary, first and foremost, that cares deeply about our risk-adjusted return. And at the same time, we care deeply about the impact outcome to people, to these key stakeholders, as we've described. And so if you step back and you think about the types of businesses that we're backing, they tend to have large hourly worker representation in their workforce. And why do I call that out? Because the turnover in the hourly workforce today in America is an enormous challenge. It really started during COVID in the frontline worker universe, but it has not meaningfully changed since. While wages are up, minimum wages are up less, right? It's starting to change, but they're up less. The wage growth disproportionately has been at the high end of our economy. And people have had access to the quote unquote side hustle. So whether that's Etsy or whether that's Uber or whether it's just a decision to leave the corporate workforce and fund yourself and allow for caregiving and other needs, that trend is undeniable. And why do I mention it? I mention it because impact and financial outcomes are inextricably intertwined here, because if you cannot attract and retain hourly workers, and they are a large portion of your workforce, you will not have a successful business. If you don't have truck drivers and people to package everything up in the warehouse, our first deal is a logistics and fulfillment business. These are essential workers to this business success. So the discussion of retaining these workers and lowering turnover and providing benefits access and making sure there's psychological safety and inclusion for them and as well as the whole workforce, it's really essential to the company's success. So I think in our case, impact is not something that's on the side as a nice to have. It's intertwined to the best financial outcomes for that company. And for us as a lender, researching their policies on people, it's improving the outcomes of success for us on our loan.
Thank you, Beata. That was a very enlightening discussion there. I'd kind of like to start winding down things a little bit for today. One of my last questions for you, because this has just been really impressive and you have such an impressive background and you've done so much. At this stage in your career, if you were sort of looking forward, how do you feel that women at your level and in your generation are influencing, will continue to influence the finance industry, particularly as career paths evolve? So you mentioned even things like sort of changes now that we're seeing in the labor market and things like that. How are you and how are women in your generation influencing the future of the industry?
Well, every generation matters and every generation has their kind of set of crises and obstacles. And I think we have to respect that there has been progress, although the progress has been painfully slow. I don't know if others on your show have cited this statistic, but the statistic really just continues to haunt and horrify me. So I'm going to shine a light on it. In asset management in the US, the Knight Foundation continues to be the leading voice of pushing for progress on diversity in asset owners, meaning portfolio managers who are driving investment decision-making in their organizations. And they continue to partner with others to create studies on who owns those decisions. And the unfortunate reality of that is their last survey showed 1.4% of portfolio managers in the US were non-white men. So 1.4%. So that obviously includes all kinds of diversity, not just gender diversity. And that's a super depressing number because, of course, women represent over 50% of the population. The Black population is about 13% of the US. Hispanic population is equally in size, 13. Asian is 4%, just to cite some statistics on that. And the fact that this 1.4% number exists just shows that there are just tremendous barriers to getting to, the seat that I was in. And I hadn't even realized that number when I was climbing my way up, but became keenly aware of it, when I started to focus much more on lifting up women and participating in panels around diversity and, of course, hiring. And I think there's a lot that we can do. First of all, I think the first thing we can do is just be conscious of inherent bias that exists. The more that we want to hire people that look like us, the less that we are building diverse teams that outperform unconditionally, even on cognitive diversity, if not on gender or ethnic diversity. Just be aware. Having introverts next to extroverts, that's a win. Extroverts like extroverts, but that doesn't mean you should build a whole team of extroverts, right? So we just need to be keenly aware of bias in hiring. So I think putting in systems that help you screen for that bias. There's great software programs that effectively edit resumes so you don't see names, and they kind of de-bias words in resumes so you have a fair look, and that starts with HR. I do believe in a diverse slate of candidates being the first entry point to hiring as a critical functional process to put in, because without a diverse slate, you stand absolutely no chance of driving change in diversity. So I think just those two things as really practical points of advice for people that are in hiring positions to really look into them and see if you can implement them in your organization. And if the organization doesn't have a mandate for a diverse slate, you could have that mandate when you're hiring, right? So you can make changes as an individual. You don't need 5,000 people to agree with you. You yourself can implement that change. And that's really important. And then flipping gears a little bit, I know you and I had talked about this idea that moving capital is also a very powerful tool to affect change. So when you join a nonprofit board, sign up for the investment committee. Even if you're not an investor, be interested in that. Ask questions about your managers. Ask questions to your consultant or advisor or internal investment committee about the diversity of your managers. Because if the statistics are 1.4% today, if people on nonprofit boards aren't asking those questions, they won't change, right? That is who's driving the capital. And people get involved in nonprofits at very early ages, but I found, maybe opt for the governance committee and think about board members, and that's great. But board members actually tend to be pretty diverse, yet the capital and the investment business is far less diverse. So I think that's a powerful tool and a real point of advice for all of us, not just women who are in these seats, that don't forget that driving capital is an incredibly powerful force for change.
Our last question today is our signature question for Deal Us In. And that question is, what advice, if you could go back or somehow get in a magical time machine and give advice to your younger 22-year-old self, what would that advice be?
Well, first of all, I'd work out more, sleep more, and probably get a dog. That just would have been better for my life. I think I prioritized a lot of my life was prioritized around work. And I don't know if I would give that advice to somebody else. But as I see my daughter and millennials right now, I think they've already learned that lesson, right? They're like, nope, we need a more balanced life. It's not all about work. And I think that's wonderful because the more that those generations enter the workforce, the more I think employers will have to respond to the demands, right? And not send emails at midnight and 6 a.m., et cetera, all things I've been guilty of my entire career. So I think work-life balance is no joke, and it's serious, and it should be respected. And I would even tell myself that, even though I started as an investment banking analyst working 100-hour weeks. I mean, there just has to be a better way. I just can't believe that that's the way it has to be anymore. But then on career advice, I would say drop the self-doubt, own the space, be confident, take out "I'm sorry" as a word in the workplace. I don't see a lot of men apologizing. I do see a lot of women apologizing, including myself. I think I still do that, and it's not a good trait. And, imposter syndrome is real, and it happens at all stages and phases. And to just check yourself on that and say, hey, what would the others think about me and my work that I'm delivering? Because if the feedback is good, take it. Don't add all the things you're not doing well to your list every day. And just wake up every morning really owning what you're doing well and lean into those superpowers. Like, identify them early and try to find a career and a job that lifts you up along with your core strengths. And I think that's really where you thrive.
Thank you, Beata. Thanks for all of your advice here and good information about the industry. I've enjoyed having you here today and learning some more about you and also getting inspired and recharged. So thank you for that. And thank you to our listeners today on our podcast.
Well, thank you, Phyllis. I really appreciate you doing the work and lifting up women's voices and Deal Us In. It takes a lot of work to run a podcast. I used to do it myself and loved it. And it's important to keep doing the work. There's just all kinds of ways we can raise our influence. And I applaud you and McGuireWoods for dedicating your time and money and effort to the work. So thank you again.
Thank you for joining us at the table for this episode of Deal Us In. If you have a recommendation for an inspiring interviewee, a question you'd like us to ask, or topic you would like to hear covered, or if you'd like to tell us about women-focused initiatives in the field, please email us at wpef@mcguirewoods.com. We look forward to hearing from you. This podcast was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this podcast, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in the podcast. The views, information, or opinions expressed during this podcast series are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This podcast should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.